Welcome to the Riskwiser Zone, the podcast where we dive into the world of finance and explore the latest developments that affect your investments and your financial well-being. I'm your host, Lewis, and I'm excited to have you join me today. We're starting off with a look at the latest report from the Federal Reserve, which highlights the top concerns for financial stability. According to the semi-annual Financial Stability Report, geopolitical risks and oil shocks are now at the top of the list, with 3/4 of respondents citing geopolitical risks as a major worry. The ongoing conflict in the Middle East and the resulting oil price shock have sent crude prices soaring above $100 a barrel, leading to inflationary pressures and potential market strains. The report also notes that artificial intelligence and private credit have risen to become prominent concerns, with half of survey respondents flagging them as potential threats to financial stability. The Fed warns that a prolonged conflict in the Middle East could drive up inflation and slow economic growth in the U.S., while sharp price movements in energy markets could lead to market strains. It's worth noting that these concerns are not just limited to the U.S., but have global implications. The rise in oil prices has already led to higher gasoline prices, which have climbed to their highest levels since July 2022. This resurgence in inflation has central bank officials worried as they try to balance monetary policy with the need to keep prices under control. We'll be taking a closer look at these developments and what they mean for your investments throughout the show. We'll also be discussing the potential risks and opportunities that arise from these trends, and talking to experts in the field to get their insights. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're diving into a fascinating story that's been making waves in the financial world. Today, we're discussing the growing concerns surrounding private credit markets. The Financial Stability Board has sounded the alarm, warning about the potential risks of deteriorating borrower quality, especially in sectors like technology and healthcare. On the other hand, the Federal Reserve has taken a more measured approach, stating that risks from private credit appear limited and manageable. Now, let's take a closer look at what's driving these concerns. The private credit market has grown exponentially over the past decade, with many investors seeking higher yields in a low interest rate environment. However, this growth has also led to increased worries about liquidity mismatches, valuation practices, and the use of private credit ratings. The Fed's report highlights that some open-end bond and loan mutual funds remain exposed to liquidity transformation risks that could cause asset fire sales in market downturns. It's essential to strike a balance between these two perspectives. While the Fed's assessment may be reassuring, it's crucial to acknowledge the potential pitfalls in private credit markets. The recent surge in redemption requests, triggered by concerns about AI disruption in the software sector, serves as a reminder that even seemingly safe investments can quickly become vulnerable. As we navigate this complex landscape, it's vital to remember that risk management is key. Regulators, investors, and lenders must work together to ensure that private credit markets remain stable and resilient. By promoting transparency, prudent lending practices, and robust oversight, we can mitigate the risks associated with private credit and foster a more sustainable financial system. In conclusion, the debate surrounding private credit markets serves as a timely reminder of the importance of vigilance and prudence in our financial decisions. As we continue to monitor these developments, it's essential to stay informed and adapt to changing market conditions. Welcome back to the Riskwiser Zone. As we wrap up today's show, I'd like to dive into a fascinating story that's been making waves in the tech industry. Intel, the chip-making giant, has been on a tear lately, with its stock rising nearly 490% over the past year. That's right, folks, this is one of the most remarkable turnarounds we've seen in recent memory. Now, you might be wondering what's behind this surge. Is it due to Intel's newfound dominance in the chip market? Not quite. While Intel has made significant progress in its manufacturing capabilities, particularly with its 18A process node, Its products haven't exactly been setting the world on fire. In fact, Nvidia and AMD continue to lead the pack in PCs, servers, and AI. So, what's driving this optimism? It seems that investors are betting on Intel's future rather than its present. The company's preliminary chip-making agreement with Apple is a major factor, as it could potentially be a game-changer for Intel's foundry business. Additionally, Intel has received government backing and is partnered with high-profile companies like Elon Musk's Terafab AI chip project. But here's the thing, Intel still has to prove that its soaring stock price is backed by actual results. The company deserves credit for getting its manufacturing capabilities back on track, but it needs to demonstrate that it can turn these promises into real market wins. As investors, we need to be cautious not to get caught up in the hype. While Intel's turnaround is certainly impressive, we must separate the signal from the noise. Is this a case of Wall Street betting on potential rather than performance? Only time will tell. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe, and until next time, keep your finances in check.